Welcome back to the channel. I'm Algabot, and this is where we break down automated trading strategies for MetaTrader 5, one expert advisor at a time. Today we're looking at a strategy called Supply Demand Rebound Hedge. It's a pure price action approach with no indicators at all. Instead, it maps the recent supply and demand zones on the chart and waits for a candle to reject those levels before stepping in. In this video, we'll walk through how it reads the market, how it manages risk with an unusual hedging layer, and we'll read the actual code together. Let's get started. So what exactly does this expert advisor do? At its heart, Supply Demand Rebound Hedge is a structural price action strategy. It doesn't use any moving averages, oscillators, or lagging indicators. Instead, it studies the raw candles and identifies where the market has recently found support and resistance. It does this by looking back over a set number of candles, 20 by default, and recording the highest high and the lowest low in that window. The highest high becomes the supply ceiling, or resistance, and the lowest low becomes the demand floor, or support. These two levels define the zone the strategy watches. Let's walk through the logic step by step. On every new candle, the strategy first checks whether it already has a position open. If it does, it manages that trade and looks no further. If it's flat, it begins mapping the zones. To map them, it scans the candles in its lookback window, skipping the two most recent, so the forming candle and the signal candle don't distort the picture. The highest high it finds becomes resistance, the supply ceiling. The lowest low becomes support, the demand floor. If the two somehow overlap, it simply waits. Next, it inspects the candle that just closed, the rejection candidate. It measures the full range of that candle, then the size of its upper and lower wicks. The wick ratio parameter, set to 0.55 by default, decides how dominant a wick must be. A value of 0.55 means the wick has to make up at least 55% of the candle's total range. Now the two signals. For a buy, the strategy needs three things at once. The candle's low must dip into the demand zone, within a tolerance band set by the zone tolerance parameter. The lower wick must be long enough to satisfy the wick ratio, and the candle must close higher than it opened. When all three line up, that's a bullish rejection of support, and the strategy signals a buy. The sell is the mirror image. The candle's high must reach into the supply zone, the upper wick must be long enough, and the candle must close lower than it opened. That's a bearish rejection of resistance, and the strategy signals a sell. Risk is handled structurally, without any indicator. On a buy, the stop loss sits just below the rejection candle's low, with a small buffer. The take profit is then placed at a multiple of that risk distance, defined by the reward ratio parameter, 2 by default, meaning the target is twice the stop distance. Finally, the hedge. If price keeps pushing against the trade toward the stop, the strategy can open one opposite direction position part of the way there, governed by the HedgeTrigger parameter. If price recovers back into the zone, the hedge is closed and the original trade is left to run. If price breaks through instead, the hedge's own target aims to offset part of the loss on the original. It's a single, one-time hedge, never a chain. Now let's read the actual MetaQuotes code, just as it appears in MetaEditor. At the top, we have the input parameters. Lookback sets how many candles define the supply and demand range. Wick ratio sets how dominant the rejection wick must be. Zone tolerance controls how close to a zone counts as a valid test. Reward ratio sets the take profit as a multiple of the risk. HedgeTrigger decides how far toward the stop the protective position becomes active. And lots is simply the order size. Below the parameters are the two rejection tests. The variable bull reject is true when the just closed candle's low reaches into the demand zone. Its lower wick is at least the wick ratio share of the candle, and it closes above its open. The variable bear reject is the opposite. The high reaches the supply zone, the upper wick is long enough, and the candle closes below its open. Then come the two signal blocks. In the buy block, when bull reject is true and bear reject is not, the strategy reads the ask price as the entry, sets the stop just below the candle's low, and calculates the take profit as the entry plus the reward ratio times the risk. It then calls trade.buy with the lot size, symbol, stop, and target. The sell block mirrors it exactly. When bear reject is true and bull reject is not, it reads the bid as the entry, places the stop just above the candle's high, sets the take profit below the entry by the same reward multiple, and calls trade.sell. Notice how both sides share identical structure. Only the direction and the side of the zone change. Let's bring this to life on the chart. What you're seeing is an illustrative euro-dollar sequence, and I've marked the two zones the strategy has mapped. The red dashed line near 1.0900 is the supply ceiling, our resistance. The green dashed line near 1.0830 is the demand floor, our support. Remember, the strategy has no indicator panel below the price. The zones themselves are the entire signal. Watch the first few candles. Price is drifting down from the middle of the range. The opening candle closes lower, the next one extends the decline, and by the third candle price is pressing right down toward the green demand line. This is the area the strategy has been waiting for. Now look closely at the next candle, because this is the important one. Price spikes below the demand floor, printing a long lower wick, but then buyers step back in and the candle closes near its high, finishing above where it opened. That long lower wick, closing back inside the zone, is exactly the bullish rejection the strategy is looking for. The wick is dominant, the low tested support, and the close is green. All three conditions are satisfied. Once that rejection candle closes, the strategy acts on the very next candle. You can see the buy entry marker placed around 1.0849. The stop loss, marked just beneath, sits a touch below the rejection wick near 1.0826, structurally protected by the low that just held. The take profit is set at twice that risk distance. From there, follow the move. The next candle pushes up, then another, each one closing higher as price lifts away from demand. By the eighth candle, price reaches the take profit level near 1.0896, and the long trade closes for a gain in this illustration. Notice how the target sits comfortably below the supply ceiling. The trade aimed to capture the move between the two zones. Now the market reaches the upper zone, and the second setup begins to form. Watch the candle that tests the red supply line. Price pushes up and actually pokes above resistance, printing a long upper wick up near 1.0913, but sellers reject it, and the candle closes back below the line, finishing lower than it opened. That's the bearish rejection of supply, a dominant upper wick, a test of resistance, and a red close. It's the mirror image of what we saw at demand. On the next candle, the sell entry marker appears, around 1.0898. The stop loss is placed just above the rejection wick near 1.0915, again protected by the structure that just held. The take profit sits twice the risk distance below the entry. Then price rolls over. The following candles close lower, one after another, as the market works its way back down through the range. By around the 12th candle, price reaches the take profit near 1.0864, and the short trade closes in this example. So in one clean sequence, you've seen both halves of the strategy, a bullish rejection at demand that led to a long, and a bearish rejection at supply that led to a short. In both cases, the strategy waited for the wick to confirm the zone was holding, entered against the test, protected the position with a structural stop, and aimed for a reward that was a multiple of the risk. Of course, real markets aren't this tidy. Zones get broken, rejections fail, and that's precisely why the hedging layer and the fixed stop loss exist, to define the risk before the trade is ever placed. This chart simply shows the ideal version of the pattern, so the logic is clear. And that's a full breakdown of the Supply Demand Rebound Hedge Expert Advisor. We covered how it maps supply and demand from recent swing highs and lows, how it waits for a wick rejection candle to confirm a zone before entering against the test, how it sets a structural stop loss and a reward multiple take profit, and how its single hedging position works to manage an adverse move. Remember, everything here is educational information only. It is not financial advice, not a recommendation, and not a solicitation to trade. Trading carries real risk, and losses are part of the process. If you found this analysis useful, please like the video, leave a comment with any strategy you'd like me to break down next, and subscribe for more MetaTrader 5 strategy analyses. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.